I'll introduce the panelists in a second, but first, this topic, it's the equity raise. Pass the hat. So obviously in self-funded searching, I would say the majority of folks are looking for equity, need to raise equity for their deals. I think there's a lot of scaredness behind it. And so these guys are, number one, going to demystify it for you, tell you how to get it done. But I can tell you, after seeing, 100, probably not 100, maybe 100 folks go through the search process, go and raise money, I promise you that there is money out there, as long as there's a good deal and a good operator behind it. And if you know how to sell yourself and sell the deal, which we're going to get into here in a second. So without further ado, I'll let the panelists introduce themselves.
I'm Ben Bortner. I'm a former searcher operator. I bought a pool company in Key West, ran that for 3 years. Before that, I was an investor, was a partner at a hedge fund for 5.5 years. So I've been investing for 15 years now, professionally, and then been investing in SMBs for past 5 or 6 years in terms of searching and operating and investing in other searchers.
Well, man, my name's Tony Cappaert. I was a SaaS founder 8 years ago, started a software business, sold it in 2019. Then randomly started buying cabins in West Virginia and built a little vacation rental investment fund and a sister property management business. Still run that and own that. It's called Blue Maple. And then building that little small business got me really interested in investing in other small businesses. And so I started a small fund called Workbench Capital, where we invest primarily in self-funded search deals, done 24 deals in the last 3 years. We'll talk more about the details, but that's high level what I do.
I'm Kevin Bibelhausen. I was a self-funded searcher who acquired his first business in January 23. So I am only 18 months ahead of some of you. And then pretty immediately after that, I joined with a couple other guys to start a fund investing back into self-funded search. So I'm also a general partner at Fruition Capital. And we have made 8 investments, check size between $600,000 and $800,000 into self-funded deals in the last year.
And I want to hear also your story on your equity raise on your deal. I know it was a lot of fun, so I'll get there later. But all right, so the same structure as all these other so same structure as these panels. We're going to hit some topics, and then we're going to open the floor later at the end for any questions that y'all have. Sound good? Cool. All right. First one we got, what are the best and worst practices when it comes to engaging with investors? So I'd like to get one example of, maybe the best example you've seen, and then an example of the worst that you've seen.
I mean, I think the best is, I don't know if it's the best, but like in general, what we're trying to figure out is this someone we can trust, and is someone's going to do what they say they're going to do and actually, deliver and be someone that we actually can work with for years in the future, right? We're investing as a small private investor, a minority investor in a deal that's maybe going to exit in 5, 6, 7 years. So I would say, I love when people come to me and they come across as fairly competent, like they've already done the research and they know what search is about. Like I don't want to be the guy educating the searcher on like how to put a deal together or like how to do a search and how to find deals. Like I'm not that person. I've never bought a business. So I think that's like maybe a don't do. And then maybe like I don't think I have a great like story around like a horrible negative or a positive, but I'd say, on the positive side, I'm shocked the number of people who I talk to and we have a good conversation and they're doing a deal and I don't hear from them again for months and months and months until they've got a deal. And like it's really hard for me as an investor to feel like I can, I know who this person is and I can back them when I've only talked to them for 20 minutes and now we're talking about a $300K investment. I think the best thing you can do is actually like touch base with just a couple bullets, like a random email or whatever, a text every few months, like just letting me know what you're up to, keeping you top of mind for me. I think it's one of the best things. That's sort of an obvious point, but I think maybe 20% of searchers do it. It's pretty great.
I think a good process is, we're looking for someone who's organized, they have a process, they know what they've kind of thought things through. So a good approach, and for me, is, you've got a 1 or 2 page teaser you've put together, kind of highlighting the business, what your thesis is, the sources and uses for the deal, how much equity you're raising, what the terms you're proposing are. And then we can determine whether it's a good fit for us. And if it is, we can, sign an NDA. Hopefully you've got a data room put together with some of the Q of E, a sim, highlighting the deal, kind of your thesis. That's a good process. I would say what not to do. Don't look up my phone number. Look up my phone number online somewhere and call me at 9 o'clock on a Sunday night.
That's a real
Which
story.
happened.
Yeah. So I'm a little bit different because I was a self-funded searcher. I don't mind talking to people in the beginning of their search. I do only have a limited amount of time since I'm full-time CEO of the business I bought. But I genuinely enjoy talking to people at all stages. The tactical thing, and so you talked about the good things to do and the bad things to do. Like the tactical solution to what you're talking about, it's like, oh, send a text or email or whatever. Start a newsletter. It's even if nobody reads it, like who cares? Because you're building an email list and you're sending out regular updates, and that is the cadence, and that is like a muscle that you need to develop, especially if you're in this room. I'm assuming you're thinking about raising capital. You're going to need to communicate with your investors on a regular basis, monthly, quarterly, whatever it is. So you might as well start now. And nobody in this room, I would bet, thinks they're just going to do one deal. Everybody thinks they're going to do multiple deals, right? So building your email list is one of the best assets that you can do, that you can give to yourself. And that's something that I didn't do in my search because I had partnered. We don't have to do this now, but like I thought I had equity, earmarked, ready to go. So I didn't really do any investor communication or any seeding the ground or doing all these intro calls or anything like that. That like the best practice would be, set up a meeting with Tony and kind of talk about what he's looking for or whatever. I didn't do that because I didn't think I had to. And then I had to kind of, go 100 miles an hour at the very end because my capital kind of fell out and I had to figure it out. So do yourself a favor and build that list.
Yeah, totally. Just to piggyback on that point too, like the same minority of searchers that are like not super engaged up front and like doing that email list and sending out the updates. It's the same post acquisition, right? It's just shocking the scant amount of updates we're actually getting, and it seems like it's pulling teeth some of the time. And I can tell you, the folks who raised 2 years ago with the like non-fixed rate SBA debt, as it flexed up, right? And these businesses were paying a lot more debt service, and the businesses were struggling. These searchers, many of them were going to their investor pool saying, "Hey, we need to raise some more capital to put in this business." If you're not talking to your investors, it's really difficult to raise that capital. Like similarly, if the business shit's hitting the fan and you want to raise more capital for whatever reason, or conversely, if you want to do a bolt-on. Right, something's going really well, and you want to actually bring more capital to buy something else. Like building that muscle is like super critical. And again, it's a small minority who do it, for what it's worth.
Awesome. All right, so y'all personally as investors, let's talk about check sizes. So I would say, what is your average check size? And on the spectrum of small, average, or big in our world, where does it fall?
Okay, so I'll go first because I think our check size is the largest. We raised our first fund in the last year, and we, like I said, deployed to 8 different deals. Our check size is between $600,000 and $800,000 usually. That check size may grow as we raise our second fund beginning in August, but that's been kind of our model. We didn't want you'll hear the various models that everybody kind of has here, but we want to be the anchor investor. So we don't necessarily want to take out your entire raise, but we want to be the large majority.
Yeah, we're a little smaller. Our typical check today is $300K. And if you just briefly on the math, right? If it's $1 million EBITDA business, typically if it's 80% levered, you're raising like $800K of outside equity, right? So that's a natural limiter to the size of the check or how your cap table is going to get constructed. So yeah, we're almost never the only investor in a deal. We're typically one of the biggest, typically not the biggest. But yeah, that's the rough size.
I typically like to be one of the lead investors, take kind of the lead on negotiating legal documents with the searcher. And for us, that's an average check size of $350,000 to $500,000 today. So
You're good, dude. I'm going to swap the order of the questions real quick because I think it just moves better in progression. So just based on the different check sizes, I know you mentioned being a lead investor, the largest investor. What are the benefits and downsides of raising a bunch of small checks from multiple investors versus securing the majority of the funds from one large investor?
I mean, I think all of us in this room who are interested in self-funded search, there's a lot of reasons for doing that, but a lot of it comes down to autonomy, being able to do your own thing, right? Calling the shots. And that means you can raise capital, and with, well, not a ton of capital, right? So mostly debt in the deal, a little bit of capital from outside investors. And if you've got some wealthy folks in your family or friends, you can bring a lot of money on the cap table doesn't have a lot of experience running or operating a business. And that can be fine. Like at the end of the day, money's green. But the trouble is that when things aren't fine, not having people on your cap table who have a vested interest in trying to help you and help the business grow, like that's being, I think, a little bit short-sighted. And so I would say what you don't want is the other extreme, right? An investor who's going to be like really difficult to work with and up in your business and constantly like being the boss you don't want. Like that, nobody wants that, obviously. But you obviously also want somebody who's going to have your back and frankly understand the business and understand the levers of growth you're trying to pull and the issues that are going on, who's going to be there to support you. And ideally, those people are also on your board. So that's I think the advantage. I see folks who are raising deals and they're you can tell trying to construct it with basically a board with no teeth and not a lot of equity investors who have a lot of experience. And I think that can work, but I think it's very risky. That's my read.
Yeah, I think there's value to bringing on an experienced investor who's been there, has run a small business, has exited. So I was a former searcher. I've operated. I enjoy working with other searchers, advising them through the closing process, dealing with bullshit that comes up, and advice on how to deal with these problems, and then strategizing on how to grow the business, things we can do to levers we can pull, making introductions to once you outgrow your SBA lender, we can look at SBIC funds, private credit, so various things we can help grow the business together. So I like to be actively involved, and I think there's some value to that. But then again, I had friends and family as investors. That there wasn't really professional investors investing in self-funded searchers back when I was a searcher. So.
All right, give me a little bit of runway on this because this is kind of my soapbox. So so the question was about small checks versus big checks. Obviously, I'm in a fund now that writes big checks. There's a reason for that because I started my search. I had an equity commitment letter from one of these capital providers that said, here's a letter that says you have $5 million of equity available to you. And that made me think that I was hot shit and I could go out and buy anything I wanted to. That turned out to be bullshit because 3 days before my LOI was signed, got a call from a partner in this firm that said, we're just super busy, so I don't know, good luck, Anyway, we're going to tear up the contract. Okay. So I had to make a decision on whether or not I could grind through it and raise small checks, or raise in general, or kill the deal. And so I went for it. I talked to, the guys that put this conference together. That's why I keep coming back, is that, these guys have made a huge impact on my life. And I was able to get my deal. I had to raise $800,000. So not the biggest raise, but also not insignificant. And I raised $50,000 at a time. My minimum check size is 50. So do the math real quick and you can figure out that my cap table is pretty large. I've got over 10 people on my cap table. My opinion is that's too many people. I love all the people on my cap table. That's a lot of people to manage, okay? Especially during tax season. So I had to grind through figuring out how to do that. I got a list, the list that Sam provides, and I raised those little checks. But gee, it would have been a hell of a lot easier to just go to a provider like I initially tried to do, who had committed to the deal that would write a large check to take out the majority of your raise. And I see this now with searchers that are bringing deals to us, and I'd be curious if you guys kind of found the same thing, where there's this thing that I think searchers kind of get in their mind, is that once you figure out the economics of a search deal, you're like, oh, I get to keep all this equity. Well, let me get as much as I possibly can and squeeze all the blood available from this rock, okay? And they split hairs over giving up an additional 5% because, investor terms, from a fund might be a little bit higher than family and friends capital, because they're not, professional investors. If you're splitting hairs over 5%, like you're thinking of, you're majoring in the minors, like you're losing the plot. Okay. The idea is to have people who know what the hell they're doing and have a real network of individuals that we can call in and be your sounding board to give you resources that you need, to give you access to things you otherwise wouldn't have had, with one text message, and you could kind of put out the bat signal, and the whole team arrives. I'm seeing a lot of people who are still focused on that, like, I got to squeeze as much equity out of this as possible, and even if that means I got to raise small checks. I'm telling you, it's incredibly stressful to do it. Doesn't mean you can't do it. I think probably everybody in this room can grind hard enough to get it done. But most of you, I would expect, have never bought before. You're going to be going through the SBA process for the first time. You're going to be going through legal for the first time and negotiating with your seller. You probably, if you're like me, guess what? My lease was up when I was acquiring my business, so I had to renegotiate a lease. And got stuck with a 30% rent increase because, why not? So like, you're going through all these other things that demand your attention. Just pay a little bit more in investor terms and just get rid of it. Like, you don't have to worry about it, and with a fund like ours, like we're investing in deals that are between $1 and $2 million in EBITDA. So we're looking for larger deals, and we never want to be the only investor on a cap table. But what we will do is take out the majority of the raise. So I raised $800K for my deal. Fruition's model will be to write like a $600,000 check and then say, okay, searcher, you need to raise 200,000. Well, 200,000 is a hell of a lot more manageable than 800. And by the way, I can also point you to individual investors that like to co-invest, and I can kind of open up my network to you so that, guess what you can do? Put them on your newsletter and start creating an investor base for yourself, because see above, you want to do more than one deal, right? So you want to start building that infrastructure and that network. End of rant.
Probably all three of us have investors that like to co-invest too. We can help make introductions, so that we also help with the whole capital raise. And then I recommend just going out and talking to other searchers that have one of us as investors, or there's the people who invest in these deals. They're on almost all the same cap tables, and so it's a small world, and you can go talk to them, and everyone's got feedback on different people probably. So
yeah. So last thing, just to maybe reemphasize, I wouldn't. I'll put myself as someone who has raised capital in a venture environment, and then all of us have LPs, have investors in our funds, right? I would never want to have one, right? I would never want to have all my eggs in one basket. So you probably want a couple. I would definitely want people who know what they're doing involved for all the reasons we talked about. I also would never take super small checks where I felt like I'm going to hear about this at Thanksgiving. That makes sense, right? Or if this check doesn't get returned, like, it's a problem. Like, it's also obvious things, but they do have weird dynamics. I have a handful of really close friends that trust me, and we've co-invested in other deals together. I won't let them be LPs in my fund because I don't want to hear about it whenever we're hanging out, right? So it's dynamics like that where I think it's just they're obvious when you say them out loud, but I think everything we're saying is not rocket science, somewhat obvious.
Perfect. Yeah. So I think I do kind of want to double click down into the raising money. Let's say you do have some friends and family capital readily available. In my case, I did raise money from a friend, a mentor, but he also was a strategic at the same time, industry veteran, knew everyone and their mom, could connect me, instant book of business for us to tap into. So I guess I just want to see your thoughts on like raising money, I guess, with more strings attached to it than not.
When you say more strings attached, yeah, what do you mean by that?
Like friends and family, like the Thanksgiving. Yeah.
I just maybe to unpack it, I think it's that point I made of, if you get the read that this money is money that can't be lost, I would never take it, right? And in fact, my friends who have invested in my funds or invested in my last company, I said as much. And pretend this money never comes back, and how do you feel about that? And if you're still cool with that, and we're still going to hang out, and it's not going to be like it's not going to change our friendship, or like, then sure, we can talk about it. But I'm just very nervous about that. Period.
I completely agree. I didn't have the opportunity to raise capital from friends and family because I don't have family money and I don't have wealthy friends. So that really wasn't a problem for me. But I also I also would never have asked, because for that exact reason, like, I just didn't want to deal with it at Thanksgiving, at Christmas, and feel like I would have soured a relationship.
I'll tell you what, though, there's nothing more motivating than raising money from your friends and family and
I believe it.
not wanting to lose that
Yeah,
money.
I believe it. That stress
And
can
that
be
is
powerful.
also when you make a lot of money for your friends and family. That's also really rewarding. So I did enjoy that part of it. So
All right, let's move on to. So I think a lot of people here know like the kind of obvious deal breakers of like, hey, I'm going to bring this deal to an investor, and they're going to say, what the hell is this? But what are some of the more non-obvious deal breakers that maybe some people out here aren't thinking about? Well, they think it might be a fantastic deal, and you look at it 2 seconds, you're like, oh, this is a no go.
I mean, I think if the margins are super high, it probably means the seller's doing a lot of the work. For me, it's new construction, a lot of new construction, or a lot of customer concentration, stuff like that.
I think about it. I mean, the deal itself has 3 components, right? There's the searcher, there's the company, and then there's like the deal terms themselves. So I guess just thinking about it in that order, on the searcher side, there's like broadly 2 types, right? There's someone who has real operating experience, and there's someone who doesn't, right? Who has primarily maybe finance experience or something. I very much over-index on someone who has real operating experience or has a surrogate for that, right? So people have mentioned a few times on stage the idea of investing in veterans. Like, I love that, right? They were deployed in the field, managing a blue-collar like force that they were working with when they were deployed. I love that profile. I can see that person working with a similar blue-collar person here in like a manufacturing company. If you don't have that background, and we'll touch on it a little later, you have to have a reason why it makes sense you want to buy that type of business, right? Maybe there's something in your childhood, your parents, whatever it is. So anyway, that's on the searcher stuff that I think about. Also, what's your like time horizon? Like, as someone who manages a small fund, I need liquidity in 5, 6, 7 years. If you're looking for a forever hold, that can be great for you. Like, maybe a great business you want to run for 30 years. But think about it, like what's then the pitch to the investor? Like, because I'm not going to be a fit unless there's a mechanism to get liquidity. So that's sort of if having not thought through that as a searcher and going into an investor conversation, or even starting the conversation of I want a forever hold, like, know that that's not going to probably not work for a lot of investors.
Well, you can have a strategy around that. You can say,
Totally,
hey,
yeah.
I'm going to recap you in 5 years or something like that. But
I think that's
Yeah.
that's sort of my point, is like having given the thought that like that's going to be a consideration is important.
I think going back to like deal breakers, I guess on searchers, I've had some searchers like, and every little thing they're just trying to get the maximum that they can get, and at some point it just becomes like, okay, this is not a good fit. This is too much.
Is it a partnership, or are
Yeah,
you
it's
just
a
an ATM
partnership,
machine?
or is it-
Yeah, I mean
ATM.
that's like jumping to the other extreme. Like on the deal term side, there are just norms, right? Like deals don't get done that are below like an 8% preferred return. And to be honest, the norm is more like 10 to 12% now. My average was 11% last year. All right, on the percent of common that you're giving to investors, right? You hear people talk about this idea of a step up. So if you're raising 20% of the deal from outside investors, because it's a highly levered deal, we need to share in that leverage with you, meaning that we're putting 20% of the proceeds in. We're going to own more than 20% of the business. It's highly risky when it's levered. If you're not doing that, right? If you're raising 20% of proceeds from investors and investors are getting 20% of the company, that's no step up, right? It's a one step up or whatever. That's just so out of market. That tells me that either one or 2 things is true. Either you're very greedy, right, and you're trying, like what you just said, Kevin, or you just don't understand. It's like an indication of ignorance. And ignorance can be okay, right? You just didn't know, but it's neither is a great look. And again, market norm is probably more like 1.8 now, right? Not. I don't see really things getting. I'm not investing in stuff below like 1.5, and I see stuff as high as 3x, and a lot of that depends on the quality of the business. I'm talking a lot, so I'll pause on the company, but those are some of the things I see as like major red flags.
Yeah, I fully agree on the terms. In fact, I think that kind of comes out of when you start to do your model, and you may have seen some templates out there, and I think the rule of thumb kind of has been 30% IRR is what you want to target when you're modeling something out. Well, as Tony can attest, most of us are not like expert modelers, and if you try and thread the needle on a 30% IRR, and that means, in your step up, you're like, oh, it only has to be a 1.2 in order to hit that 30% IRR. Like maybe you should increase that to 2, and then the investors can share in the increased economics, and then it'll be a more attractive deal for them to take down, right? Because I think I think a lot of searchers, and I mean, I kind of did this too, where it's like you look at the IRR and then you sort of back into the terms by what the target IRR should be. And I don't think that's necessarily the right way to look at it, because if you do it that way, you're treating it as pure capital. If you basically try and spread the wealth a little bit more, you're treating us as partners. And that's how I feel about it. I feel like that's a little bit more inclusive, and a good return for the amount of risk that we're taking in investing in a highly leveraged deal.
Awesome. So I would say most searchers are coming from, corporate backgrounds, W-2, worked a job their whole life. With maybe they managed a P&L within an organization, but never, was the boss, if you will, managing an organization with little operational experience. So, and obviously that's a big component of running a business, right? They're stepping into the driver's seat without having never been the driver. So what are some strategies that you've seen, searchers without operational experience get seasoned investors like y'all comfortable backing them?
Well, I didn't have any operating experience when I bought my company, so it was all new to me. But I think just a humbleness, willingness to learn, that kind of attitude. Again, the thought out strategy of how you're going to manage this business, these people, how you're going to be able to relate to them, that kind of stuff.
Yeah, I mean, I think there's two things I'm asking myself, and by the way, I think most searchers who I encounter are in that bucket, right? So it's very common. I think there's two things I'm asking myself. One is, can you operate this business? Are you going to be successful doing it? And the second is, will you want to operate this business, right? And both of those, I think, especially if you don't have experience in the industry, which almost none of us do, we're buying a business, and if you don't have any operating experience, I think leading the conversation with that, like calling out the elephant in the room, like, well, this is why I'm interested in search for XYZ reason. And ideally, it's not a spreadsheet reason, right? It's like we all know, or we all at least believe, this is a great way to drive high return, great way to drive wealth for ourselves and those who are involved with the deal. But that can't be the main reason. It can't be the main reason why you want to buy a random manufacturing business in Ohio, right? And like, is there something from your background, your child, whatever? So and then that answers maybe the why you want to do it, and you're not going to be there, and all of a sudden you want to get the hell out. And then on the why you can and how you can operate, why you can operate. I mean, people have all kinds of experiences in undergrad or in different jobs that they've had, just demonstrating that you can be very operational. This is sort of a bit of a wishy-washy answer, but just leading with knowing that that's a concern of your investor and trying to speak to the fact that you can do things and you have done things that are very technical, that are not in a white-collar office environment. That is it's a better signal. It's the best signal you can do. And anything that indicates that, I think, is strong.
I think we're all kind of dancing around project management. Like, you don't necessarily have to be an executive in a company, but what kind of projects have you managed? What kind of teams have you led? It doesn't even have to be at work. Like, just tell me a story. Tell me why you think that'll translate to the business that you're going to buy. And I'll just, again, I think fit is incredibly important too. So like, so you're talking a lot about blue collar businesses, because that's, I think, what you typically are investing in. Yeah. So I do a lot more in logistics, distribution, some manufacturing. We actually don't invest in home service businesses. First Capital doesn't. We're B2B only. Okay. Take a look at the way that I'm dressed. I've got a jacket. I've got green jeans and like a fashion color glasses. Okay. If I show up to an investor meeting and I'm like, I got this hot roofing company, and I can buy it at like 2.5x, and I'm going to run the cruise at 7 a.m. I have no credit. But what the hell do I know about running a roofing business and managing that workforce? That's not who I am. I was talking to Chris Williams. I don't know if he's in here, but he's the guy who runs System 6. He's one of the sponsors here, and we were talking about it last night. And like, he's like, I like to play golf on the weekends. I like to do this. Like, yeah, like, buy a business that fits you. That doesn't fit that doesn't fit like what the books say or what everybody says you're supposed to buy. Or like, I bought a textile company. Okay, it's a white collar, design focused business that also has a distribution arm, right? Like, it's not the HVAC, plumbing, pool cleaning, whatever kind of company. It's a very different vibe, and that fits me a hell of a lot better than trying to go buy an HVAC business because that's the hot thing to do. So those are the kind of two things, right? Like, fit, with the actual company, and then think about your experience beyond necessarily what your job title is at work. Think about the projects that you've managed, the teams that you've led, in any sort of walk of your life, any sort of aspect in your life.
It sort of begs the point too, as I'm hearing you reflect on it, Kevin. Paired searchers are really attractive from an investor perspective, and I think it should be obvious why that's the case, right? You have two different personas and backgrounds. One could be a lot more operational background. One could be a lot more maybe go-to-market or finance background. I've done several deals like that, and I love it. It's a small minority of the search community in self-funded that does the paired search. And not that I think you should totally. No one in this room is going to rip up their plan to buy a business and say, "Oh, I definitely should get a co-founder now and buy this thing." But I do think there's tremendous value in that. And so, if you are considering in early stages, and there is somebody you're close to that maybe is also thinking of buying something, I think it would be really compelling and probably could be better for everyone involved, the investor, you, and the business, to potentially do a pair with somebody else.
Nice. All right. So when y'all are looking and analyzing investments that are coming across your desk, do y'all have a certain North Star metric or a certain threshold that you're looking at, whether it's IRR, MOIC, ownership percentage, step up, et cetera, and why?
Yeah, I mean, Kevin touched on it earlier. Like IRR, I look at IRR as the lead dog, like the North Star, whatever. 35% at 5 years is what I'm looking for. The trouble with doing that is there's a lot of ways to manipulate the forward-looking model to get to that 35%. So there's like two obvious ones, right? The one are, what are the base case assumptions that you're making in terms of future growth of the business, margins in the business, and the exit multiple? I want to assume in the base case that all of that is the same as what the business has done historically. So if you're not doing that, for example, you're going to buy the business for 4x and you assume in the base case you're going to sell for 6x, and that's how you got to your 35%, like that's not conservative, I don't think. And so that's like I'm going to rebuild that model. And then similarly, this is maybe more of a subtle nuance point, but the cash distributions coming out of the business, a lot of people get to that 35% IRR by assuming they're going to distribute a lot of free cash flow to investors early on. That may happen. And some of the deals in which I've done, that's been the case. But the vast majority of them, they don't return a lot of cash or any cash in years like 1 and 2. You're reinvesting in the business. You're trying to grow more aggressively. You want to build a cash buffer for if shit hits the fan. And when you don't return cash, or maybe say the opposite, when you do return cash early, or at least you assume it in the model, it's an easy way to inflate the IRR. So I kind of use it as the North Star, but with the caveats I mentioned that like everything has to be fairly conservative on how you're getting to that.
So I'm smirking because I've heard him give that talk before. So in the March, I didn't tell you this. So at the March SMB boot camp, I was in the back of the room, and you were doing that, and I couldn't help but laugh because it's 100% true when you talk about early free cash distributions. I know that it can juice IRR because I did it. Like I modeled that way. And so I had a 50-something% IRR. It's like, I am fucking awesome at this. Okay. Like this is a slam dunk of a deal. No, I was just stupid. Like I just didn't know any better. So like you can make those mistakes, but when somebody calls your baby ugly, your model, like you have to listen, like there's people that I've made those mistakes, better than to make those mistakes, right? It's cool, kind of school of hard knocks versus, a lot more experience, but like, those are things that we see all the time. And we look at IRR as well. We model in the 30s as well. We want to see that, as far as like criteria, we're B2B only. Like I said, we don't do home services businesses. We want to see 10 plus years in business. I don't think that's true for everybody up here. And then we don't want anything in technology. So like somebody brought us a Salesforce deal. It's like, oh, it's a Salesforce consultancy. Nice business, not for us. Too much platform risk.
I assume you're IRR focused too, yeah?
I actually don't give a fuck what your model looks like. I'm not going to look at it. I'm not going to use it. I'll have my own. But I'm looking for a quality business that is not going to be too economically sensitive, that you're paying a reasonable price for, and you're financing it conservatively or reasonably, and the investor economics are fair and reasonable, and you've got a good plan, and I can see you running it and growing it. And that if we just kind of do, to your point, like have a conservative case where we just kind of have steady growth, maybe a slight multiple expansion as we hopefully professionalize the business a bit. That's going to hopefully be a strong outcome. And then if we can do some more strategic things, it's going to be a home run, hopefully, and hopefully I can help guide to that.
Yeah, I would say the reason I think of IR and I look at the modeling exercise, it's when the businesses are different. And if you've got one business, which has historically for the last 10 years grown, let's say at 20%, both top line and EBITDA, and you've got another business that's been growing 5%, like those investor terms should not be the same because the former business is a better business. Everything else being equal, I'm painting in very broad brushstrokes. And so the investor term is going to be worse because I am more confident that even with slightly worse investor terms, I'm still likely to have a great outcome as an investor. Whereas if it's only growing 5%, it's like, of course I'm going to have to own more of the business, have a higher preferred return, like because the business isn't as at least attractive in the sense of future growth. So that's how I think about it.
Well, if we can do some add-on acquisitions or some other strategic things to grow that value, the organic growth of the business doesn't have to determine how the business actually grows once you own it. So.
Nice. I guess we're going to do 2 more questions and we're going to open it up and then we're going to go do some fun activities after. Real quick, so what are some of the best and worst practices, just piggybacking off the negotiating term sheets, what are the best and worst practices for negotiating term sheets and legal docs with professional or potential investors?
I don't know what best and worst practices are. I have a kind of a term sheet that I like to use. There's pretty standard ones that are floating around. SMB has theirs. Mine's pretty much a copy of it. And I've just added a few things, tweaked a few other things, but I don't think there's anything crazy. I mean, typically, you should be thinking about, one, your salary should be capped and it should be a reasonable, I don't think, you shouldn't be making all your money on your salary. You're here to grow the business, get a huge equity check when you cash out. That's what I want to see. I want to see you fully, all in on the deal, and you're going to make the money when you grow the business, not from getting a $250,000 salary or something. But so typical minority rights, like anything, if you want to take on more debt, issue more equity, that kind of stuff is all going to be approved by a majority of the minority. So that would be the outside investors, stuff like that.
Yeah, I'd say maybe to piggyback on Ben's point, I don't know if there's good or bad things to do, apart from I think it's very reasonable and it's very standard where the couple of lead investors will take the docs from your attorney and will bring them to our attorney to mark them up, right? Because each of our respective attorneys obviously is going to be doing what's best for you and best for us, and we're going to try to come to something fair. Like that's very standard. I do encounter searchers every once in a while where deals under contract, we're getting close to the finish line, the cap table's filled, and no investors are requested even to look at the docs, and there's a little bit of surprise on the searcher's part that we would want to mark them up, redline them, and just that's a very normal thing. And I also think it's also very normal to ask for what those minor costs from the investor's attorney to be paid for in the transaction.
Don't wait till the last week to circulate an operating agreement and all that kind of stuff.
Yeah, I mean, I agree with all that, and I think the other thing is negotiating term sheets, right? Like it depends on whether or not you're going to do the small check thing or you're going to go get an anchor investor. The anchor investor will have a lot more say over that term sheet, and you're going to take their red line seriously because they've got more cash that they're putting into the deal. If you do the small check thing, then you have a lot more power. You can do it. You can go out and find that money. It's just more of a grind. And so it depends on, what are you willing to give up? Do you want to have this done and be able to move on to the next thing, and you're willing to give more preferential terms? Great. If you feel like you need to own 85, 90% of that business and you won't be able to sleep at night unless you own the vast majority, then go do the small check thing. Because you do, control a lot more because those small check investors don't have a lot of power. So it really is kind of a choose your own adventure.
Yeah, if we're negotiating over little finite, minute details, that's what we were focused on. It's probably not. It's a bad signal about we can have fair terms that's fair for everyone, and we're all going to crush it. But if we're focused on little details, then it's a red flag.
Cool. All right, let's open it up for questions. We'll go, Matthias.
When is the best time for a searcher to reach one of these? When they're under LOI, pre-LOI, deals? What do you guys prefer?
I always tell people, to Kevin's point, what you don't want is get under contract and then you're like scrambling to get capital together. So I would put together a list of maybe 10-ish investors that write checks, that are active, and reach out to us, have that early conversation, early in the search. Do it one call, and then put us on the email list and drip us with like updates. Don't spend a ton of time on that because it's a waste. But make sure you've got a handful where it gives you like the peace of mind that when you get under contract, you can move. And then wait till the deal's under contract. Right. Because we're seeing a lot of deals, and if it's not under contract yet, it's like, I don't want to dig into a lot of the material if it might go away next week. So that's, I think, general rule of thumb.
Yeah, so as you mentioned, you're seeing private hurdles go higher because of interest rates, but given a lot of private funds in the space, are you seeing that cleanup will come down along the same terms you guys have all highlighted, like the small checks? What's the minimum threshold of governance that you accept?
I can hop in and you guys want. Yeah. They definitely are both going up. We could maybe hypothesize as to why. So the question was like, I said the preferred return average is, I've seen go higher, and the step ups, like the amount of equity the searchers are giving up, is also going up. I think my gut, it feels somewhat counterintuitive because it feels like there's a lot of excitement in the self-funded search community right now. Like, of course, there's more equity dollars coming into the space. I don't know that that's actually true. Like, the terms are better. So I don't know what the dynamic is, but I can tell you empirically, that's what I'm seeing, is that the quality deals that I'm investing in have slightly better terms for investors. Obviously, the searchers are still getting the vast majority of the equity, and like it's still, I think, fair for everybody, but they're slightly better. What was the other half of the question? Oh, governance minimum threshold. A real board with 2 representatives from the searcher, 2 representatives from the investor, 1 independent that's mutually agreed upon. And then there's like a bulleted list of kind of all of us similar, like things that we want the board to be able to do, like, issue debt, the salary of the searcher, sell the business, right? So I would say that's probably the minimum. And where there isn't a real board, right, with real investors on it, would give me pause.
I think we're all going to have kind of the same answer on that one as far as governance goes, because we're all writing larger checks for the space. Like we're not writing $25,000, $50,000 checks. So we're all going to require some, serious level of governance. Nothing. We can't. It's not traditional search. We can't fire you, right? But we're going to we want it to be treated like a real company. And to Tony's point, it's a board, and representation on the board.
And we have a fiduciary responsibility to our investors as well to make sure that we have proper governance and stuff. So.
Going back to the question of taking friends and family money versus investor money, I think it'd be useful to hear some experience here, your stories around some of the tangible value that you've been able to add to your portfolio companies as investors. You mentioned like, hey, you want to get out the SBA, go the SBIC route one. Just put some color to that so that some of the students can see the value of investors versus friends and family.
I feel like I'm always talking first, but I can give you the quick answer. Up front, I would say it's immediate connections to other investors to fill the cap table, placing someone who's experienced from the industry on the board, either from an LP in our fund or someone in my network. Those are probably the 2 biggest things right off the bat. And then thereafter, it's a sounding board for all the operational and people-related stuff that you're going to deal with. All of us have run businesses. All of us have managed and fired and hired people. And I would say that's very helpful to have someone who's been an operator on your side.
So I would say I've been working with one of my portfolio companies with his acquisition strategy, making introductions to lenders to refinance his debt and take on more debt, as well as making introductions to potential buyers, whether that's strategics or private equity groups that might be interested, and they have their own platforms. So stuff like that, trying to drive the value a lot.
I'll talk a little bit about operationally too. Like, we've got partnerships with growth marketing firms, people that we've vetted like service providers, right? So we're talking a lot about, the service providers that you need to get a deal done. Okay, great. What about when you're actually in the chair? So we've made a conscious effort to develop relationships with people who can help scale that business. And we've, frankly, a lot of them have been contractors I've churned through, and I've learned like, oh, this guy's awesome, or this not so good. So we're not gonna refer them. So I've already done a lot of that diligence, and when we're bringing them on. Marketing, like coaching communities, anything like that. Finance and accounting, just different, pricing analysts, things like that. I mean, just things that you wouldn't have normal. I mean, you could go find them, sure. But I mean, the reason you're here is to develop a network of people that have their own networks and have trusted resources that they can share with you. Right. So that really is the benefit. And sure, your friends and family may have those too, but we don't have any we're not going to see you at Thanksgiving. We didn't change your diapers. We didn't do anything like that. So it's purely business for us in these relationships. And if they suck, we wouldn't recommend them.
Oh, thank you. Jeff? Yeah, you talked about normally groups like you guys have better terms than, call it friends and family. On one given deal, if a searcher was going to take a check from you guys, does friends and family kind of fall into the same deal terms, or do they get different terms on that one same deal?
Generally everybody has the same terms.
Yeah, I would say yes. Yes, that's what I've seen. I would say if you wanted to do something different, I've not seen it. I've seen it in real estate, but it's like based on a minimum check. So then it's explicit. You share that. So what I wouldn't want, and think about it if you were an investor, like friends and family, you wouldn't want it done behind closed doors, where you feel like, oh, someone else got better deal. But if you're explicit in the deal docs that if you trip a minimum threshold of investment, you get, this preferred return or something, that is standard. And it's not standard in search, but it's standard in other assets. And I think it's very reasonable to do that here.
So I did something similar to that. So instead of better economic terms, so my minimum check was 50. If you invested 100 or more, so it was certain, I think it was like 3% or more ownership in the deal, I gave you a board seat. So you have more capital at risk. You should have the opportunity to either sit on the board or name somebody to sit on the board on your behalf. And I was explicit about that in my operating agreement.
Maybe we should push for better terms.
Sit on a searcher and try to find an anchor investor. So Kevin, Dan, yes, sorry. And I haven't met any of you guys. I don't know the searchers you've invested. How should I be doing my diligence on you so I don't get sucked by pants that predicament?
I mean, you can ask us for I think each of us probably have a website. We list some portfolio companies on there. You could independently go and reach out to them. I would back channel every person I hire, I do back channel references. So you can ask me for a reference. I'll give you a reference. It'll be glowing, but talk to someone who I didn't introduce you to. And it's, I think, fairly easy to find. But like I said, look on our website, look at portfolio companies. That's the way.
And if you've been in the space for more than a minute, you know that everybody is pretty giving of their time. Reach out to the portfolio company CEOs, ask around people, here, if they've ever worked with us before. It's also, listen to your gut, because, I knew it wasn't a good fit with the firm that ended up dropping me. But I didn't feel like I had any other choice. And so I just kind of kept walking down that road because I didn't know any better. And then, I ended up being right, which is something that sucks to be right about. But I think you kind of know you're functionally getting married to these people. Like you own something together. You might as well invest. You might as well buy something with people that you actually enjoy. And when you go, so I travel all the time for my business now. So I was in Indiana. I don't know, a couple months ago. And, one of the guys on my board, on my cap table, one of my larger investors, I made sure I went out and, had lunch with them. They're people I genuinely want to go and talk to. If you have, a cap table full of people that you don't really like, and that you roll your eyes every time they call you or send you an email, you're going to have a bad time.
Just speaking on the point, I haven't thought enough about this, but it reminds me of hiring. And I would say what I explicitly ask when I do a reference on hiring is, would you hire this person again? Obviously. So I would say, would you allow them to invest again? I'd also ask, when I'm hiring, I say, if I'm going to be Tony's manager, what can I do to best make that relationship work well? And I think it'd be interesting, again, I'm just riffing on this, but I think it'd be interesting to ask folks we've like invested with what they would say, like, what is the best way to work with Tony? They might have unique insight that could be valuable on how to, like, frankly, get value out of all of us.
Yeah, what like how does so when you're early investing, like, what is do you have an exit strategy, or is it vague, or is it like, hey, we for sure are going to stitch this together with this other entity, or is there always a playbook, or is it more vague? Is there some process behind it that you can speak to?
Are you talking deal by deal, or are you talking like with the funds, like
Deal by deal.
deal by deal?
Yeah.
Definitely not deal by deal for us. So we invested in a towing company. It was our first deal. And then that deal went awesome. And his brother ended up wanting to buy a towing company, I don't know, a couple hours away, maybe closer. Well, they're going to roll it up, and they've already got a PE buyer waiting in the wings. That wasn't planned. He was planning to hold the company forever and just recap us out, but things happen. So it's, and I don't think you should go in with too firm of an idea. I think you should be opportunistic, which is exactly, I think, what everybody says about when you're looking for a company. Like, you have your criteria, but be opportunistic about what comes across your path. Same thing, when after you've bought, be open to the various paths before you.
Yeah, I just try to confirm that that I'm aligned with the searcher on there being a path to exit in 5 to 7 years. And I think that can come in 3 flavors, right? The one flavor is the searcher who explicitly wants to do this. If the business is doing well, they're going to have a ton of their net worth tied up in that business. And they know they want the liquidity because they want to go on to something else, maybe invest or whatever else. So that can be a means of alignment. The second is, we were talking about the cap table earlier. I like to know who else is on the cap table to understand to what degree and I want to meet them to understand to what degree they have the cash and the interest, if the business is doing well, to potentially buy me out in 5 to 7 years, right? So that's a potential method. And the third is the most explicit, is just to put a put option in the agreement that allows, as an investor, the ability to sell our shares back, assuming the business has the cash flow to allow it, at like a fair market value at year 5 or 7. So I've been pushing for that latter because I just think it makes it explicit. I think it makes it fair. And I think I think it eases the ability for larger investors and funds to get to invest in deals, right? To see that line of sight of liquidity.
I'm just hoping that you have a plan. I guess I'm like, we're taking this, so, and that our plans are aligned.
That's a really funny question. Yeah, I mean, like we were talking not 2 hours ago or so about how many. So like when I was raising, and definitely Ben, when you were raising, like this didn't exist. Like the funds didn't exist. It was all like individual investors. I don't view us as competitors at all. In fact, we've something I was going to talk to these guys a little bit later about was I started a Slack channel with a couple other funds, and I'm going to invite them to that Slack channel because we all like to collaborate and talk and share deal flow. It's like, oh, this is not for me, but maybe it's for you. Like so I said we don't invest in technology businesses. Well, that may not be a big deal for these guys or another fund. So they can have it, and just kind of talk about best practices and how we can pool resources and help. Cause we're all like, this is rising tide lifts all boats. Like I don't view us as competitors.
Yeah, I think here's how it works in practice, which is, if I'm going to invest in a deal, I want confirmation this makes sense. So first I go to my LPs and I offer, hey, here's what we're doing. Here's the check that we're writing. Here's why I like it. Here's what I'm concerned about. If any of you all are invested or interested in investing, let me know. I'll make a connection. Once I do that, if there's still room in the cap table, I want to share it with other really good investors because it's good for the business or for the searcher. And it's really good for the business to actually have other like smart investors on the cap table. So it's somewhat self-serving in that sense. And so I share deals regularly. We all do. We're on cap tables together. The towing deal he's talking about, I'm on that cap table. Like that That's very regular. And I suppose there definitely are deals where I'm coming in as one of the last checks. And so by definition, there's no room. I'm not going to share it. So it's competitive in that sense, but it's almost like it's just the onus on me to meet early, so I have the ability to share it out.
Any more questions? All right. Oh, thank you.
So Ben, you made a comment about private credit earlier. Is convertible debt like ever something that you guys have considered, or has it come across? Some of your VC space. So I think that there's like usually like some sort of opportunity. Like, is this ever being explored? Why doesn't it exist? Convertible debt is like it's almost like you get an option, buy, and you put the money in instead of an SBA loan, or some, I don't know, something in that realm for the option to get more equity at a certain valuation. Why doesn't it exist?
Yeah, it doesn't exist. You're right. I don't see it. I can't. Yeah. I don't know enough about the drivers of the convertible note in the startup world. I think, yeah, other than the part, there was already an angel ecosystem that was very, very active, and it was a way to price the deals without having to like spend a bunch of money on attorneys. So like, let's just like to back up. The reason why convertible debt, I think, existed is you would have a convertible note. It was a very standardized instrument to raise money if you're like an early stage startup. And rather than having to go to an attorney and spend $40,000 structuring your raise when you're raising 500K, it's like, well, let's just do this note, this convertible note that it's going to have a cap to the valuation. And when we do that big raise, it'll just convert to equity then. So it's technically debt in the short term, but no one who's investing on a convertible note in the startup world thinks of it as debt. They think about it as just a cheap way to price the equity, and they're eventually going to own equity. So I think it's just because that mechanism like wasn't needed, or there is debt in this world that it's, I don't know. That's my read.
Talking about as an alternative to SBA, or
Well, yeah, I mean,
I think it's hard to compete with SBA.
Sorry, guys. Okay, so when you talk about like opportunities in the future, right? If you talk about private credit, talking about typical structures, like from your seat as investors, like you see opportunities like these alternative products, talking to SBIC, things like that that are just like a little bit different. Like if you started to see them, are they coming down market from the independent sponsor, upper, lower, middle market type deals? You know, everybody's kind of getting pushed down. I'm just curious.
The SBIC funds that I've talked to, they're kind of in the 2 to 3 million EBITDA kind of minimum size.
They're not coming down.
So if you've got a larger deal, that's probably who you want to be talking to.
And I'm not sure. I mean, we'd have to ask Lisa. She probably knows whether convertible debt is allowed or not in an SBA deal. I don't know.
So there's interpretations.
Of course there
So
are.
we can talk to our credit group about that, and if and this, we don't think that our current interpretation would see that as being eligible.
Yeah.
I mean, what we're getting participating preferred equity, which has a similar economic payout structure as a convertible note would have. So,
Steve, one last question, Taylor. It's kind of a follow up on that, but like, how do you guys think about SBA debt as investors? Like, are you just investing in self-funded search and that's the mechanism everybody's using? Or does it feel almost competitive because you're getting less equity because they're able to get such favorable debt from the SBA? What's the thinking around SBA debt as an investor?
Because of the flavor of deals that I like, that I think are more conservative, which is a business that's been very consistent in its revenue profile, but modestly growing, right? If it's a business is only growing 10% annually, and I shared earlier in the base case, I don't want to assume it does any better. There's an only way to get the 35% return I'm looking for is if it's levered, right? And so I am optimizing. What I love about the SBA debt is that it's high leverage, and Lisa and other SBA lenders are doing a lot of work to scrutinize the deal to ensure that that service can be paid. And because, again, I'm not doing a deal unless it has very consistent revenue track record, it's like, great, we're going to lever a business that's very consistent. It's going to just enhance the returns. So I love that. That's the flavor that I like. I'm somewhat agnostic as to whether it's SBA debt or other forms of debt, but it's the high leverage that I like about it. If you guys feel similarly.
I mean, we'll do independent sponsor deals. But I'll tell you what, like there's nothing like signing a $5 million personal guarantee to know that somebody has skin in the game. I mean, I value that very highly. And that really does align our interests as investors with the searcher. Like I had an investor, this comment got back to me by way of another investor in my cap table, that there's something compelling about somebody who's willing to push all the chips in the center on a textile, furniture company, in North Carolina, like pick up and move his family, like completely change his life in order to go buy this business and like make it happen. And I'm not unique and by any stretch of the imagination there, like a lot of searchers are doing that. And so there is just something compelling about somebody who's just willing to put it all on the line and just say, fuck it. Like, I'm going to go make this happen. And that is the difference with other debt, right? There's no recourse in some of that other debt. I don't know. Like that's tough as we kind of end up going up market. I really like this space because you've got some real skin in the game. There's nothing like signing that PG.
Yeah, I mean, it's effectively government subsidized debt, and like to see the people all in and have the PG like these guys. So.
All right, I got a couple of housekeeping stuff, but before, let's give a big round of applause for our awesome stuff. You guys, pressure. Good stuff.